वेलकम टू वेब क्लास। वेब क्लास में आपका स्वागत है। वी आर इनटू ट्रेनिंग एंड डेवलपमेंट ऑफ सॉफ्टवेयर फॉर म्यूचुअल फंड डिस्ट्रीब्यूटर्स। आज ट्रेनिंग के बारे में बात करना है। वेलकम बैक। नाउ लेट अस सी द डिफरेंट टाइप ऑफ रिस्क। लेट अस से we are starting with the equity risk. Fine, equity risk, and the risk associated with the equity as an asset class, you can say. Now remember, in the last program we said that three risk, which is total risk, is equal to, no, this is very important concept for anyone who is dealing in equity stocks or portfolio, both. Now both will be explained under over here. So systematic risk plus unsystematic risk. Now you can say what these three words means to us. Now first of all, let us start with the unsystematic risk. This is a risk which is associated with one single script. For example, let us say if you say I have invested in Infosys, fine, you have got a great performance. You say I have invested in something called Kingfisher, oh my god, so you have all the losses. Means there is always an uncertainty of performance associated with one script, one stock. So if anybody is investing in a stock, he is exposed to this unsystematic risk. Yes. Now, how to deal with this? Very simple. Look at the mutual fund and their fund manager. They do not invest in one stock for its portfolio creation. No. What they do is that they buy so many stocks in its portfolio. When they buy so many stocks in the portfolio, the process is called diversification. No, the simple literal explanation of diversification is that do not put all your egg into one basket. You must have read this somewhere. So when you diversify your portfolio, what happens is that allocation of a stock, allocation of your investable amount is segregated across different stock, leading to the diminishing risk, diminishing uncertainty associated with each stock. No, so many stocks, all are called together in diversified. So diversified portfolio will have a little lesser risk. That's one aspect. Now second aspect is that when you are doing diversification, what is the second thing that you do over here is that you create a correlation which is basically more of an inverse in nature. So correlation is what? Correlation is about impact of two stocks onto each other. No, there are so many stocks and you can create impact on each other. So correlation is about the impact relationship between two stocks and thereby its impact on the risk of the stock. Correlation coefficient, popularly known as, no, this can be from -1 to +1. No, the moment you say correlation coefficient is -1, this correlation coefficient of correlation or correlation coefficient, both are same word. So when coefficient correlation or coefficient of correlation of the diversified portfolio stocks, no, if this is towards -1, they are perfectly inversely correlated. That means the risk will be nullified. The risk of one will be nullifying the others, which is of course a more of a theoretical process. We cannot get this kind of portfolio where a stocks has got inverse correlation to the extent of -1. But of course it should not be also +1, it should be near about in between that. So the more you have an inverse correlation, means less than 0, and of course towards -1 side, the more you have inverse correlation, the better diversified portfolio you create. So the bottom line is that whenever a fund manager of a mutual fund or of a PMS builds a portfolio, he tend to reduce the unsystematic risk associated with a stock by making a diversified portfolio, and that diversified portfolio among its stock will have a inverse correlation, will not be perfectly inverse, but will be having a inverse correlation, so that this risk can further be reduced. So of course unsystematic risk can be reduced. That's the one bottom line. So it can be reduced, it can be managed, it can be reduced, it can be managed. That is one thing that we come to know. That is why also we say that investment in mutual fund is a less risky than investment in a stock. When you say this sentence, no, investment in mutual fund, which is a portfolio, is less risky than investment in a stock, what it means? It means that a stock will carry lot of unsystematic risk, but a portfolio will not carry so much of an unsystematic risk. Fair enough? Okay. Then comes the systematic risk. That's the second part of it. Popularly known also as a market risk. No, if you go into market, no, popularly known as the word called market risk. No, if you like to associate or recall one sentence that is very often published and as a disclaimer in all the television media and advertisement, no, that's the investment in mutual fund is subject to market risk. Please read our document carefully before making investment. No. So what is that market risk which you cannot say no? As per this disclaimer, what it says that if you are investing in market, if you are investing in capital market, the market risk cannot be said to be no. You have to take it. That's a systematic risk. Market risk is the other name of systematic risk. Yes, you cannot say no to system-driven risk, systematic risk. Okay. For example, suppose somebody wants to invest in India. Now he has to accept the depreciating currency. Somebody wants to invest in, say, America, he has to accept the low growth regime. No, every country, every system will have certain parameters. Some are good, some are not so good. And so if anybody is investing in that universe, investing in that kind of a market, so that risk has to be taken care of that. So market risk, you cannot say no to this risk, and this is measured by something called beta. No, the very important word, the beta. What is the beta? Beta is ratio of the performance. Beta is the ratio of performance between, let us say, performance of a scheme and performance of a benchmark. No. So performance of a scheme and performance of a benchmark. So that is the ratio, and that ratio is nothing but something called beta. Beta. No. If you know the linear relationship, you will find y is equal to ax plus b, and this a is called popularly as a slope. No, this is slope. This is nothing but the beta. This is nothing but the beta. Fine. You can also, if you are a student of coordinate geometry, you will say y2 minus y1 upon x2 minus x1. This is nothing but the slope. No, that's the intercept on the y-axis, and that's the intercept on the x-axis. And this is applicable for the larger changes. No, larger changes. So we use this coordinate geometry to find out this slope, and that is nothing but the beta for our narration. You can see this. Suppose you are a student of a calculus. So there the changes are very, very small, and that is measured, and there we say dy upon dx. Again, the same concept is there. No, dy upon dx, a small change on the y-axis and a small change on the x-axis. The ratio is again, that is called slope, the beta. So you can use these all concepts wherever you find this. No, this will give you nothing but a concept of the beta. Fine. Come back to beta then. So beta is nothing but the ratio between the performance of a scheme and the performance of a benchmark. Now if suppose beta is equal to 1, interesting thing, if beta is equal to 1, that means the performance of a scheme is equal to the performance of benchmark. No, so that is nothing but like index fund. In mutual fund, the index fund, that is a passively managed fund. In mutual fund, you have an index fund, that is a passively managed fund, and in that passively managed fund, the beta is always 1. That is also called risk neutral. Means the performance and the risk of the scheme will be as much as equal to the benchmark. So it's called risk neutral. No, if beta is more than 1, oh, that means you have taken more risk. You have taken more risk. And if beta is less than 1, that means you have taken a lesser risk. It's called risk averse fund. No, risk averse fund. You can also write here risk enabled fund. No, if beta is more than 1, you have taken more risk. And beta is equal to 1 is nothing but an index fund. That's a risk neutral. You can write here risk neutral. So these are the explanation of beta. Beta is measurement of systematic risk, and systematic risk you cannot say no. That means every mutual fund is exposed to systematic risk. Now you see interesting aspect. Mutual fund is an investment product. Mutual fund is a long-term investment. Mutual fund is a strategic method of investment. Fine. So mutual fund is also said to be like that. Time in the market, unlike timing the market. No. Time in the market. So these are all the words that are associated with the systematic risk, market risk, long-term investment, portfolio investment. That is fine. But if you happen to meet and speak to somebody who is a trader in the market, no, who does trading in the market, could be in derivative or in the cash segment, he will give you some different picture. What he will say is that, okay, fine, in the portfolio segment, in the long-term investment narratives, the beta is something that you cannot say no. You have to accept the beta. You have to admit that risk into your portfolio. But for those who are trading in the stock market, they have something called a concept called beta hazing. We will explain this concept in detail in the coming videos, not now. So beta hazing is a concept that is employed by the traders, not by the investors. Investment is a different concept. Trading is a different concept. Investment means long term, trading means short term. When you are doing investment, actually you have to accept the systematic risk. You have to welcome the beta as it is in your portfolio. But if you are trading for short term in the market, in that case, there's a concept, there's a tool called beta hazing. That means you can hedge the beta risk. That means you can reduce, or you can say at the most, you can eliminate the risk associated because of beta. Yes, you can do that. Any trader will say like that. So for investment market, beta has a different dimension and different meanings. And for the trading market, beta has got different implications, different understanding. Fine. So that is the one thing about the systematic risk and unsystematic risk. Then comes in the last, what about the total risk? So add the two. And what we see is that if you add the two, all the risk has got its function, its bearing in the price. So price formation. So this total risk is nothing but the measured by the standard deviation. No, a standard deviation. So what is this? This is the deviation from the mean. Okay, deviation from the mean. So mean is nothing but mu. We represent mean by the mu, and standard deviation by something called sigma. No, this is called sigma. Remember these words. So standard deviation is a measurement of total risk. You may ask me, how does this look like? No. The last one, how does this look like? Look here, I am depicting here a risk return matrix often made by mutual fund guys. No, they will often make this because they have a range of schemes. And what they will put return on the y-axis. Always put the return on the y-axis and always put risk on the x-axis. Why? Because y is the outcome of x. Return is the outcome of risk. Return is the function of x. Fine. Function of your risk. That is why you keep it at the y. And then among all the schemes, just make a plot of this. So you are plotting this here, and I plot it like that. This is debt, so low risk and low return. Then you have a hybrid, so low risk and low return. You have a equity, so low risk and high risk and high return. So this way you are plotting it. Fine. And then you say, let me plot all the standard deviation of all the schemes put together here, and then you find this kind of picture. You can see this. No, this is the deviation. It is going up and up and up, and no, you can see this. This is going up and up. No, as you proceed towards equity, the risk goes up. Equity, the risk goes up. The SD goes up. Can you see this? Risk goes up, SD goes up, deviation goes up. You can say uncertainty goes up. Yeah, you can have a positive return, you can have a negative return from the mean, that is a mu. Fine. So this standard deviation is deviation. If you see in the debt segment, no, in mutual fund debt segment, for example, if I give you an example for you to understand, let us say they have a scheme called liquid fund. Now liquid fund, the mean return, mean return could be say around, say suppose 5.5%, and SD is suppose say 0.25%. Then the probability of you having a range, one SD range, and we will have a 1 SD, 2 SD, 3 SD. That's a different concept explained using a standard normal distribution curve. We will explain that also in some coming videos. So right now you will say for 1 SD deviation 5.5 plus 0.25, so it will give you maximum 5.75, and minimum it can give you 5.25. So you will get a range of 1 SD. Similarly you can go and probability of that is of course differently explained and all. We will discuss this a little later, not now. So this gives you a range. If you go into say equity segment, let us say talk about something called sector fund, very risky fund from mutual fund perspective. Mutual fund perspective, very risky fund. So what do you mean by very risky fund? The SD will be very high, could be say 16 or 18, let us say 18, and mean return, mu return is could be say let us say 16% on a very higher side. No, you have taken higher risk. So it can give you 16 plus 18 could be together, they can give you say something like 34%. Possible, 1 SD I am talking about, and it can also give you minus 2%. So I am talking about 1 SD. Similarly you can talk about 2 SD and then 3 SD. So all these narratives are explained in terms of a standard normal distribution curve. No. So total risk is a very, very fantastic measurement of, it measures in terms of deviation in the price of your underlying. Remember this sentence. It measures in terms of the deviation in the price of the underlying. When price goes up and comes down from the mean, we measure this deviation. So with this price variation, we are able to know the changes happening in the stock price or in the portfolio price. And with this change, the last sentence of this program is that the changes in the price of the security is called volatility. The rate of change of price is called volatility. So all these words are associated here. Standard deviations measure volatility, beta measures sensitivity of a portfolio, and unsystematic risk can be diversified away through a meaningful, through a purposeful, through a very calibrated diversification. Inversely correlated diversification. Inversely correlated diversification. So these are the method through which you need to know the total risk, systematic risk and unsystematic risk. Very, very often used for the all kind of equity. Fair enough? Read this, listen to this at least twice or thrice, pick up every sentence, try to explain those sentences and try to practice speaking. Listening alone will not help you unless you practice or write. Unless you practice to speak or write, then only it will be helping you. Good. Thank you. You can visit us at our website WebClass.in or at our research website research.webclass.in. You will get a lot to know about mutual fund schemes research. We also develop mutual fund distributors websites, and you can see it on mfd.webclass.in. You can write to us at my mail ID sanatbharadwaj@gmail.com. You can also write at services@webclass.in. My number is 8910492919.